Hi, everyone. This is Jason Brack of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. We're recording this interview on Tuesday, December 16th, 2025. The US dollar gold price is over $4,300. The silver price has rocketed a lot lately. The last 9 months, I want to say it's gapped up from about $45. It gapped up to about $63, $64. This is $64.19 when we're recording this interview. The asset prices have been juiced. The Fed just announced another rate cut despite global M2 hitting $96 trillion, an all-time high. Today's special guest is a first-time guest, but I've been following his work for a couple months now over on social media and reading his blog articles. He has an outstanding track record that my listeners might not be aware of. He was warning people about the problems in the semiconductor, Nvidia, artificial intelligence, OpenAI for the last couple of years. Finally, it's coming to light. He was initially called a conspiracy theorist. People are calling him crazy. A lot of the stuff that's been coming out the last couple of months have proven him correct. He also has been making some amazing calls on the silver market there with sources there, talking to sources in Shenzhen in China and also in Hong Kong. Dario, thank you for joining me.
Thanks a lot. Happy to be here.
So Dario, how long have you been publishing your macro blog for?
The story of my macro blog is very interesting because actually I started just Dario.com because I was a bit worried I could have get like banned from social media for what I was writing at that time. Because back in especially like in 2023, in mid 2023, if you say anything about you know that wasn't like along with mainstream narrative of semiconductor and whatever, like the amount of hatred that you got at that time was really high, and it was painful, like from a personal perspective. But then, you know, in a moment of a bit of anger, I was like, people were like, doing community notes on my post and stuff like that. And I was like, but the community note is wrong. And then I'm like, okay, you know what? Let me put my articles on a blog, so that is gonna stay there and nobody can delete it. Okay. And if anything goes wrong on social media. So actually that's how the blog started, because before, I was just, actually a lot of my long forms were even on X before they allowed like these article formats and other stuff. So yeah, this is the real story. And as you said, like, actually I don't write only about semiconductor. I am I would describe myself as a very analytical person. I have I have a strong background in macro and fixed income because I did that professionally for many years. And to be fair with you, I think a lot of people that are out there, that I call them macro tourists, they should have spent a little bit more time on the desk, rather than like, you know, um, spending too much time building a persona and broadcasting idea that they sell well because they sound good, but more often than not, they don't make sense.
Also, a
So
lot of these macro experts, to add to your points there, have really bad track records. A lot of them used to be bond fund managers at an investment bank. They got fired from their job, and then they hired an expensive consultant or marketing expert for six figures to rebrand themselves, like you said, as a macro expert. But they're biased. They have huge confirmation bias for U.S. Treasury bonds, deflation, Keynesian economics. And your analysis has a lot of good insights there. I think you've been putting out articles, on Japan, your recent article in the last, 2 weeks, you're talking about how central banks are driving in the rearview mirror.
yeah, that's actually my latest article, and it builds up on a very, it's the last of a long series of articles. The one that I wrote about the Fed and the policy mistake they're doing is actually um, back in August last year, and then there was another one in 2023, and it was funny because I remember very vividly the end of 2023. all the investment banks were saying, "Oh, the Fed is going to cut 6 to 7 times next year." And I was like, actually, sorry, my mistake. 2022. I need to go even further. In 2022, they were saying, "Oh, like the Fed is like hiking rates, but they cannot hike too much, whatever." And then effectively they stopped because there was the banking crisis, and then they had to stop. And then towards the end of the year, they were saying, "Oh, the Fed is going to cut 6 to 7 times." And the thing that shocked me the most is at the end of 2023 and at the end of 2024, all these banks and analysts, as they like to call themselves, they were, if you look at the yield forecast of 10-year US treasuries, the consensus was like 3%. Right now, as we speak, the 10-year US treasury is at 4.15%. The 30-year is at 4.82%. So why I'm saying this? Because I wrote this article that, a lot of things are difficult to understand. I realize that, especially when they are counterintuitive. People think that if the Fed lower rates, yields should come down. But that's not really how things work. Like the Fed and other central banks, in reality, they have tight control only on a very small portion of the interest rate curve.
So you're saying then that the Fed can't control what the 10-year, 20-year, 30-year US Treasury bond yields unless they officially announce what a quantitative easing program, more than an Operation Twist. They have to say explicitly that they're going to start buying the long end of the yield curve.
Exactly. This exactly. And it might come shocking to your audience, but the US has been doing effectively yield curve control for the past almost 2 years, if my memory is correct. Janet Yellen started it. They don't call it yield curve control anymore. They call them treasury buybacks. What is a treasury buyback? So why the yields are not even higher right now? Because this is another important fact. Yields didn't come down, but didn't even explode. And if you look at the level of deficits, if you look at the level of debt in the United States, but not only in the United States, in many countries out there, actually, this is going on across the board. The reason is it's too simple for people to believe, but effectively what the US Treasury Department has been doing, coordinating with the Fed, that is another thing that shouldn't happen. I mean, the Fed in theory should be independent, in theory, but in reality, they have been front-loading the issuance of Treasury bills to the extent that next year, there is going to be 9 trillion up for refinancing. It's a huge amount, T-bills. So they're issuing more T-bills than they need because the yield of those is capped by the Federal Reserve. And they're using that extra money that they're getting from that source of funding to buy back US Treasury on the longer end of the curve, especially the 10 years, in order to control interest rates. This is yield curve control. In the same way, the Federal Reserve just announced, how do they call it? Reserve management operation or something like that.
It's a stupid name. Yeah, they're just going to increase the reserves into the fractional reserve banking system because the reserves. I think I showed this chart on my X profile and I sent it to you. We're back at 2019 repo crisis levels, despite all the global M2 hitting 96 trillion, all this liquidity floating around in there. That means the banking system in the United States, the commercial banking system, is not sound right now if the reserve levels are that low.
Exactly. So this is very important. The Fed, the lag of time between QT nominally speaking, because they never did it for real, but let's call it QT. And QE, it's been 12 days. 12 days. I mean, and a thing that is very important to understand is that the higher the amount of debt and money supply in the system, the lower the control the central banks have on that stack of supply, to the extent that every time there is a crisis, every time there is something going wrong, the amount of central banking intervention in the system is growing exponentially. And people think in pillars, in isolated buckets, but in reality, the financial system is very global, is incredibly global. So what the Bank of Japan does, what the Federal Reserve does, what the Bank of England does, what the Swiss National Bank does, and whatever, they have ripple effect across other system in different order of magnitude, okay? But back to what you were saying, the ultimate statement of how central banks as a whole, because let's not forget, these people talk to each other. And they are becoming more and more politicians rather than central bankers. And the M2 money supply global in the system kept going higher and higher no matter what. And that is a perfect indicator of monetary inflation.
And the stagflation too. I mean, didn't Jerome Powell say like 12 months ago, he said there wouldn't be any stagflation? And then I think like last week at the press conference, it basically sounds like he didn't admit word for word it was stagflation, but he kind of danced around that we have stagflation now.
Oh, this is another very, very, very interesting topic. So how GDP is measured, the gross domestic product. The gross domestic product, as it is measured today, as in the equation, the number that you see in the that people see in the headline there is the real growth. Okay, what does this mean? Does it mean that the GDP is being calculated and then the level of inflation measured by the BLS in the US, measured by other public agencies around the world, is then deducted to show the amount of real growth? But here is the thing. According to BLS data, in the past 10 years, the level of inflation in the US has been 36% in the past 10 years. You live in the US, but I can make this example in any other country around the world. Is your cost of living just increased by 36% in the past 10 years? Yes or no?
I'd say no. I'd say it might have increased by 36% in the last 5, 6, 7 years.
Exactly. Exactly. This is the thing. And furthermore, there is a problem with this measure. There is a problem with the statistics. And here I make an example that I like to do because it's stupid yet powerful. When you use statistics, in particular when you use averages, if you have 10 people and 10 chicken, everyone is going to have 1 chicken for dinner. However, when you look a bit closer, you see that one person has 9 chicken and the other 9 people, they need to split 1 chicken. So statistics is telling you, is giving you a picture of the reality that doesn't take in consideration the impact on the different layers of society. So, long story short, as a whole, the inflation level has been so obviously kept like suppressed on a in the public measurement. Why? Because of GDP. So you have to keep showing you're growing. But is the economy really growing out there? The level of defaults and Chapter 11 filing in the US is at beyond recession level. The level of defaults on consumer debt, delinquencies on various form of loan and whatever, is at recession level. The level of default in the commercial real estate space is at historic heights never seen before. The level of transactions in the real estate market in many countries are down to a trickle. And I can continue this. And this is not just in the US, is across the globe. So to conclude on this topic, in the same way I was saying for years, I actually wrote an article about that, how the BLS was lying, because even according to their own numbers, in their own numbers, 1 + 1 was not equal to 2. 1 + 1 was equal like to 7 when they were talking about employment in the US. And then it comes later than during the previous administration, they overstated like the employment by what, 2 million jobs overall? I mean,
Yeah,
man.
it got revised down. I mean, and the Bureau of Labor Statistics, I agree with you. It plays games with the GDP numbers. They don't even use the real CPI data for adjusting for real GDP growth. They don't even use the CPI. They use some other type of deflator. So it's nominal GDP growth. They don't even talk about it being nominal GDP growth, even though the numbers that they talk about in the business TV here in the US is nominal GDP growth, not even subtracting the CPI. The jobs reports are always revised downwards. They used to count what government employee jobs and part-time jobs the same as full-time jobs. And the consumer price index, I mean, I basically call that either the CPI or the changing propaganda index. I'm not a fan of Keynesian aggregates anyway, the point you made about Keynesian aggregates, because these companies, I mean, a lot of them, what they do, shrinkflation, they substitute goods. So you might be paying a similar price at the grocery store or restaurant, but the portion size is down a lot. So there's tricks that the companies themselves play that the consumer price index is not going to be able to account for anyway.
Oh man, don't get me started on that, because I have oof. I mean, we can talk for hours, but I'm not sure
What
how entertaining is gonna be.
so it sounds like you're not a deflationist then, although we could like the real economy has a recession, but it sounds like the politicians, the central bankers do not want to allow real deflation.
Man, I am a person that lives in the real world. I'm a person that goes to the supermarket, that talks to small business owners, that, you know, still check, keeps the old bills and check how price changes and whatever. And people out there that are talking about deflation, with all due respect, they don't know what they're talking about. We might be in a disinflation. That means that the level of the growth of inflation is slowing. Okay, fine. Deflation is when prices come down. And I have a personal, case of deflation. As people know, I live in Hong Kong. I never have made mystery of it. It's actually quite funny, because now X and social media, they have they have these new location features, and so many people are coming out like in all sort of like weird location and whatever. For me, I always put Hong Kong out there, so I never made mystery. So I go to China very often, and in China there is deflation. I mean, prices are going down. But why prices are going down? Because, paradoxically speaking, China is more of a capitalist economy right now than what Western capitalist economy are. The level of competition across businesses in China is brutal, and this has been driving prices down to a degree that these people, like, are basically trying to kill each other to gain business, metaphorically speaking. But on the other side, you see the benefit on the population. You go in China. I traveled across the country quite a lot, so it's not only a matter of specific location. Yes, things are different right now. The type of spending changed, but restaurants are full, malls are full, people go around. The economy, you can see a level of comfort in the vast amount of the population that, frankly speaking, when I traveled to London, Paris, I traveled to New York this year, I mean, I was shocked how different things. I mean, I remember when I was living in London around 15 years ago, restaurants were all full. You couldn't, if you didn't book well in advance or whatever, like even small restaurants, it's hard to get a seat. Now they're half empty when they're lucky. And on one side of the globe, the politicians keep telling you that a good level of inflation is good for the economy. And on the other side of the globe, you have deflation that is not good for companies. I mean, if you compare the stock market of China with the US, they are 2 miles apart, 2 worlds away, even if they are the first and second largest economy in the world. But the level of comfort in the population is completely different. And this should really give people thoughts. I mean, historically speaking, deflation is the one that created the middle class, is the one that allowed people in the middle and lower parts of the society to build up wealth and climb the ladder. On the opposite side, when you had extreme cases of inflation in history, you can talk about the Roman Empire, you can talk about the French Republic, you can talk about China as well, when they invented the paper currency and they had crazy amount of monetary inflation. Everything ended up with significant turmoil in the society, because at the end of the day, you come to a point that people see one narrative that everything is going well, but then they don't benefit from that, and it starts hurting them. And when I read data like the 25% of people using buy now, pay later in the US use that to buy food, that is a huge warning bell that should be taken in consideration. So all people out there talking about deflation, especially in countries like US, UK, or even Europe, I'm like, what you guys are talking about? Do you even know what deflation means?
I think it's ideological bias, because I think like the Keynesians, the people went to specific business schools, economic programs, they're taught to look for deflation, look for that liquidity trap. Well, guess what? All these policies are creating boom and bust cycles, artificial boom and bust cycles. So what with the new one is private credit. That's the new one. That's the new credit boom, and it looks like it's going to be a bust. I don't know how it's going to get bailed out. You've been covering this in articles, as well as the data centers. So now there's data center debt that looks like it's going to be bad because the cash flows aren't going to end up supporting that. So we're having these credit boom and bust cycles. And if there were a free market, I would agree there would be deflation. But I think like the central bankers, the politicians, the bureaucrats, the people in power in Washington, D.C., or some of these other power centers, they don't seem to want to allow deflation for a bunch of different reasons.
Of course, because, I mean, when you have deflation and you have a lot of debt, that's a problem. So they are effectively, what has been going on for many years is to basically inflate your debt away. that's what's going on. That's why. So deflation is a problem for governments that have a lot of debt and unsustainable deficits, because this is another thing. I mean, economics is a social science. It's not like physics. Okay, physics, you have rules, you prove it, you experiment, and there are certain type of law. Economics is more of a social science, and as a matter of a social science, people should understand how it connects with other components in the social landscape around it, with which economics interacts. And when you have election every 2 years, for example, in the US, and every vote counts, what are the benefits for someone in power to take the necessary measures that are going to be painful in the short terms, like medicines are bitter, they're not nice, but they're good for your body, but you have to take them, right? Or maybe you need to do a surgery that is going to be bad, but in the long term, they're going to fix you. So no one wants to deliver that amount of necessary pain in order to put the economy on a healthy, sustainable, long-term path, because that's not going to be rewarded, politically speaking. You're not going to see the benefit of those actions before the next elections. And people are going to be angry. They're like, oh, you took away my benefits here. You took away my privilege years and whatever and whatnot. Okay. And this correlates to everything. I mean, now there is this data center thing that I've been saying for so long. I mean, I've been like such a broken record, but in business, like all other things, cash matters, right?
Cash flow is king. Yeah. Free cash flow, especially.
So cash matters. So any business, no matter what, no matter data center or whatever, any type of business is sound when the cash flows sustains the operation, and any eventual debt used to finance purchases is ultimately being repaid. An economy based on zombie public government, zombie companies, that they can only survive if they are able to not only refinance their debt, but raise larger and larger quantity of debt, it's not healthy. You are extracting wealth from the good part of the economy into the sick part of the economy, effectively allowing a cancer to spread rather than containing it. So,
are you referring to the U.S. government and like the size of the budget deficits and the national debt, how the government keeps growing in size and spending?
I'm referring to not just the U.S. government, and you can see this everywhere in the world. I mean, look at the Japanese government. Like now, people like talk about Japan more, and the previous prime minister tried briefly, Ishiba, to take some economic measures to cut some costs and whatever, and of course, like it didn't end up well, and for himself. And then you have the next lady now in power that is like, they just approved $120 billion equivalent stimulus package, the largest in Japan history. So it's not
Is the stimulus going to actually invest in the real economy, or is it just going to buy Japanese government bonds with yield curve control to monetize debt with new currency?
So what is actually very funny here is that how these stimulus are being justified It's like inflation is high in Japan. People are struggling. Let's give them money to ease their pain. And then you have the US government that's already saying, we are going to distribute 2,000 US dollar steamy checks out of the tariffs that we are raising as a dividend to the population and whatnot. That's not a dividend. I mean, a government, imagine the government as a company. You have assets and liabilities, okay? So you run a business, you're supposed to make a profit, the size of your balance sheet increases, okay? But then you can only distribute dividends if you have healthy free cash flow, and then you distribute dividends. The cash side of your assets decreases, the equity side of our liabilities decreases as a result, but that is not going to impair the health of the business. However, if you have assets and liabilities, you have a questionable chunk of equity, but you don't have cash, and you raise debt to pay dividends, what are you going to do? The cost of that debt is not going to benefit at all the business. You're not going to buy new machinery. You're not going to expand your warehousing, your distribution network, or whatever. You're simply raising debt that is going to cost you interest to distribute cash to your shareholder. But that can ultimately continue to a point where the cost of your debt is going to impair the health of your operation. So this is exactly what's happening. If governments don't understand that they have to tackle the deficit problem first, this is a spiral that is only going to make things worse in the long run. It's not going to make them better. There is no way it's going to make it better in the grand scheme of things.
And it's going to impoverish their own citizens, or most of their own citizens who can't afford to buy the assets or inflation hedges, because like the gold price in Japanese yen has gone parabolic. The gold price in US dollars has started to go parabolic as well. The gold price in basically every major currency, it was going parabolic before the US dollar gold price. So I think like this policy, it's been intentional that they figured they don't want to cut the government spending, the budget deficits, like you say, and the only release valve was to monetize debt or to debase the currency.
Exactly. So that's the bottom line. It's currency debasement. So as you said it correctly, the part of the population that is not wise enough to hold assets and protect their purchasing power is going to suffer more and more. And when you live in an era of extreme consumerism, I mean, in the latest Black Friday in the US, if I'm not wrong, 95% of the purchases have been financed with credit. I mean, people keep buying things they cannot afford. What is the statistic? Like 50% of the population doesn't have like enough cash savings for any like, emergency spending or any issue or whatever. I mean,
and that was before the job losses from HBN1 visa, and now what the companies are blaming it on artificial intelligence. But I think that just might be a smokescreen, right? Press release saying we're investing in AI and that's why we're firing employees.
Of course, that's a completely smokescreen. I mean, whoever uses, I mean, every company out there that try to implement AI. I mean, let me be clear on this. I always say all the time, I said it on X, I'm bullish on AI. I'm a co-founder of an AI company. So AI, similar to internet, is going to be beneficial to society. But what we are seeing right now is not AI. What we are seeing right now is I don't know how to call it without sounding like
It's a waste of capital, inefficient. It's like they're saying it's AI, but what
mm,
is it? Mostly just building data centers. It seems like it's benefiting only what a handful of companies. What your OpenAI, Nvidia, Broadcom, Taiwan Semiconductor. It's only benefiting and big tech. So what? Under 10 companies.
okay, let me say one thing. When a product is successful, right? When it sells, when it makes revenues, right? So people are happy to pay for that product. As always speak, now ChatGPT has been launched over 3 years ago, 3 years and 1 month. The revenues that OpenAI managed to bring in are minuscule compared to the amount of capital invested, are minuscule. And when I read research reports stating that OpenAI, according to their projections that are bullish, their revenue projection and growing whatever, still is expected to burn $320 billion in the next 4 years. I'm like, who the hell is going to give them that money?
Yeah, aren't
There
they
is,
losing market share? They're losing on the free side for the free version of ChatGPT. Aren't they losing market share to Chinese ones and Google Gemini 3? They're losing market share in the free version. And then I think they have the paying customers have been canceling because the free versions of the AI software that are coming out are better than the pay version for ChatGPT.
that's correct. And this is another thing that I have been telling people. I wrote an article the 25th of January, remember, when I said, sometimes I'm a bit provocative in my titles, but that's a little bit of my style. I said the era of AI charlatans comes to an end. The real era of AI begin. And I wrote that because the release of the DeepSeek model came 24 hours after you had Mazason, Sam Altman, and Larry Ellison at the White House saying that they're going to spend like $500 billion to build AI in the US. Money that none of those companies had. But whatever, like these big numbers, you know, they grab the headlines, people love them and whatever. And now you have DeepSeek coming out. And DeepSeek, the open source is open source, first of all. Secondly, you can run it on a laptop. You can download it and run it on, of course, not like a cheap laptop. You need to be a little bit more powerful, but you can run it on a laptop. I mean, let me repeat this again. On a laptop.
So you don't need your point is that you don't need a data center then?
Exactly. And
So then
that's
if you don't need a data center, then you don't necessarily need all those expensive Nvidia GPUs.
so I'm not like a tech expert from an electronic component. There are people that are super intelligent out there and they know a lot. And what they told me is that, man, all this thing that is happening to memories. These people are trying to force the consumers to run their software, their calculation on the cloud. While in reality, all these models, you will need a tiny amount of GPUs for training. But then once the model is trained and operational, because of the efficient improvement on the software side, you will be able to running on a laptop. And this is scaring the shit out of them. They don't want people to run these models locally. Hence, they're trying to kill the consumer market for memory because you need a lot of memory to run those. So you see where I'm going here. I mean,
Well, you'll also have big tech companies like Google, right? And Google is working on not using any NVIDIA chips with the latest video text to video software, Nano Banana, and the latest their LLM, which is Gemini 3. What they were trained without an NVIDIA GPU. Google has switched over to TPU. I think there's other companies, Meta, I think, Anthropic. Amazon's making their own custom chips. ASICs, I sent you that from Anastasia, who has over 10 years of experience working in semiconductors. So you have what this looks like. Free market forces deflation. This doesn't look like the monopoly that Nvidia had the last 3 or 4 years.
Exactly. So what I mean, man, I wrote and talked so much about Nvidia that every time I hear this name, I get a bit of nausea, to be fair with you. But what they've been doing is in front of everyone's eyes. Now they have nowhere to hide. I mean, when I saw the Wall Street Journal article about circular financing and everyone started to talk about that, when I've been saying that for ages. I mean, I'm like, guys, look at the number. There's no real revenues here. This is money going around. I mean, and I have everything on record. And people should really ask the question. I mean, they were saying, oh, the narrative was like, oh, they are selling showers to people looking for gold. Okay, where is the gold? Where is the gold?
Well, who's making the money then off the artificial intelligence software? Yeah, that's a question then. So it's not OpenAI because when OpenAI tries to increase the capex spending, they're not getting the cash flows from the capex spending. So they're not getting more paying customers, they're not charging a higher price, but the normal stuff from another business.
Exactly. And
And this brings me back to an article that you just put out recently. You're like, will the US government have to end up bailing out the data center companies like Oracle or OpenAI or some of the others that are announcing these ridiculously high capital spending deals for data centers and buying NVIDIA chips because of the cash flows here aren't there to justify a lot of the spending projects? Because if they're like a bad commercial real estate developer from the 80s or 90s that built like a hotel or a casino on speculation because they're not the odds of them getting the cash flow to pay off all the debt that they're using to build these things out, the probability is pretty low, I would say.
exactly, this is what, when people ask me this question, I always tell them, man, the only entity that can burn that amount of money left available are governments. That's it. There's not much elsewhere. That's government. So, and now it comes to a point that are governments that willing to take the risk of giving that much money to these companies when effectively, so far, the benefit for the broader society has been, let's say, negligible. I think it's fair to say negligible.
Well, most governments hate big tech. I mean, the only one that seems to be friends with them is the Washington D.C. Both political parties seems to be buddy buddy now with a lot of these tech bro billionaires.
Well, I don't want to comment on politics and this kind of things because it's not my field, but some things
Well,
are not nice.
well,
You
let's
cannot,
just
yeah.
Well, let's just talk about history then for the US government, because I know you wrote a recent piece about Little Bighorn with Oracle and some
Oh
of the
yeah.
but I mean in terms of like the US federal government, the US federal government has a long history, unfortunately, of subsidies and bailouts for these large scale infrastructure projects dating back to canal projects that were inefficient and bloated and wasteful and corrupt. And then after the Civil War, you also had all these railroads that were built out by a bunch of companies. There was congressmen in certain districts that got, unbidded contracts to their friend who was running a railroad company, and there were bailouts. It was a mess. So I hope that we don't go down this route. But unfortunately, I know Washington, D.C., and I think both political parties, if there's enough money involved for some of the, for other people with deals later on, maybe they get a seat on the board of directors, or they have a friend or family member involved at one of the tech companies or a job or something like that. I think there will be bailouts. I hope I'm wrong, but unfortunately, I think like history says, I'm going to be proven right.
Yeah, that's exactly the thing. I mean, what worries me is like when the vast majority of GDP growth in the latest year, in particular this year, is due to all this, like all that's going on about data center construction and whatever. Effectively, if that isn't there anymore, what's going to happen to the growth?
Well, they'll have to find another
So,
bubble because it seems like the last couple
exactly.
decades, Dario, that they've gone from bubble to bubble to bubble. Really, since like Alan Greenspan was the Fed chairman, he just focused on inflating asset prices with the wealth effect and creating new credit bubbles. And even Paul Krugman, right after the tech bubble burst, he was writing op-eds, let's create a real estate bubble.
Exactly. Exactly. That's totally correct.
Yep. So we have a bubble economy, and I even heard recently like Trump had his like economic advisors, Larry Kudlow, some of the other talking heads that go on business TV, and they started mentioning the phrase, and I hate this phrase, the wealth effect again.
Yeah. You know what scares me a lot? People think the AI bubble is the biggest one out there. That's far from being the case.
What
The biggest
bubbles would you
bubble,
say are the biggest bubbles?
the biggest bubble out there is the bubble in the banking system. The amount of debt and non-performing assets in the banking system, but most, like even more scary, in the shadow banking system, the completely unregulated one, that according to the latest analysis has ballooned to 250, I think I read 250, over $250 billion, if I'm not wrong, without capital,
Is that private credit or is that something else?
private credit. Private credit, also like pension fund investing in private credit, is all connected. And I am a fixed income guy, as I said at the beginning, by training, and I spend a lot of time into the like sitting on the plumbing of the financial system. You know, I was one of those people that, by the nature of his job, I was sitting on top of the Chinese wall. So I was seeing both sides of what's happening into the banking system, and the degree of mispricing and manipulation on the mark to market of those assets that is going on right now is astounding. The losses are beyond anyone's imaginations.
Is this similar to like 2005, 6, and 7, where a lot of those garbage mortgage-backed securities were chopped up and rubber stamped by the agencies as like AAA credit rating, that they were, investment grade, very, very safe. But we knew in reality that what the agencies were getting bribed to rubber stamp these things as investment grade. Is it very similar to back then?
Yes, but the size is way bigger, way bigger than that. And I'm not sure if you saw my article on this matter. I wrote about the latest stress test that the Federal Reserve run, and they excluded exposure to private credit. That is the largest item in major banks' balance sheets right now. They excluded it.
Wow. Well,
And they're like,
you also have, it's very illiquid, this stuff to sell, similar to mortgage-backed securities from the 2005, 6, and 7. So these things are liquid to sell. You said they're mispriced. They're worth like pennies on the dollar compared to what the companies are valuing them on their balance sheet. On top of this, you also have entities, insurance companies, pension funds. You have university endowments that bought into the stuff. It was viewed at the time when they bought this stuff was as a safe investment grade income product. And now that we're seeing that the when the tide goes out, that the emperor has no clothes.
exactly. What makes me very worried is that the level of, to the extent that these people are hiding the information right now, like how obscure banks accounting became during the year, how big has been the shift from mark-to-market accounting, from proper mark-to-market accounting to hold-to-maturity type of account. And what's even worse is that the regulators know. There is a paper written, I think in December last year, 1 year ago, by the New York Fed that basically was telling banks, we know that you are inflating the value of your commercial mortgage-backed securities. We know that you are negotiating with all these borrowers to effectively extend and pretend and not to record a delinquency and write off the value of that asset. And then you see reports in the United States of buildings, skyscrapers, real estate communities, whatever. Then when they go into bankruptcy court and then they are sold for 70, 80, 90% lower prices than the previous transaction on record, where the banks financed that purchase for tens of millions of dollars. And that's not and those are not isolated cases. That's the thing. They keep talking about isolated cases, but you cannot have hundreds of isolated cases. You get what I mean?
Yeah, this is a huge, many trillions of dollars commercial real estate bubble, but you're saying that the private credit, is it mostly commercial real estate or is it other stuff too in there?
Private credit spreads across commercial mortgage-backed securities. Mortgage-backed security, especially, they were like, during COVID time, I remember there were Blackstone, BlackRock, and other funds that were buying entire community developments, single-family housings and whatever, or rent. And you have the CLO market. You have the asset-backed securities auto loan market that is beyond ridiculous. I mean, you talk about rating agencies giving AAA rating to garbage, right? I mean, just take a look at the ABS tranches of Carvana out there. Just look at what is inside. There is, most of the assets there is auto loans to, it's not even subprime borrowers, it's undocumented.
Well, on top of that, if it's a new car, I mean, the value of the car depreciates so rapidly too. So the car loan is worth way more than the actual car, the underlying asset, which is depreciating rapidly in value.
That's correct. So here I said already publicly many times, I'm like, guys, all your eyes are on this AI bubble, whatever, like these valuations are so over bloated and whatnot. Fine. But then people say, oh, the AI companies are too big to fail. And I'm like, man, they're not too big to fail. I mean, compare the size of the balance sheet of JP Morgan with the size of the balance sheet of Nvidia. I mean, JP Morgan is too big to fail. If JP Morgan goes bust, it will never do, we go back to barter. Like, whatever
they'll destroy
money,
the currency before they allow a too big to fail bank to go bankrupt. They'll devalue the currency further. They'll allow additional accounting rules to it. They suspended the FASB in March of 2009. People forget about this. They suspended mark-to-market accounting to save the big banks because Citibank was leveraged 100 to 1.
Yeah.
So they'll move the goalposts, they'll do bailouts, they'll change the rules. I mean, all this though, Dario, and this brings me back to gold and silver. Rather than, bet on a stock market crash or, betting on deflation hedges, the traditional deflation hedges like US Treasury bonds, I think kind of like the safest short here is to just have gold and silver exposure. You have like a currency instability hedge, you have a stock market crash hedge, inflation deflation hedge, gold and silver, especially gold. If there is a deflation, gold will be a good hedge outside of the system because we don't know what rules changes or goalpost moving or bailouts or whatever the people in power are planning for us. Because the stuff you laid out, I mean, like it's math, it's numbers, but the people in power, they could change the rules on us and rug pull us.
Exactly. So this is effectively my weakness. I am nerdy number guys. So I love numbers. I put numbers out there in the field that I'm familiar with. I do a ton of research. I crunch the numbers. I love forensic accounting and stuff like that. But people don't like numbers. People love narratives. Narratives are easy. Narratives are sexy, especially when the price action confirms the narrative and validates that. It's like, man, like things are going to the moon. What are you talking about? And I'm like, sure, but this is what the numbers are saying. So there's a little bit of discrepancy here, guys. I'm like, yeah, but prices are going up, and fine. I'm like, guys, I mean, I wish you like make good profit, but don't forget to cash out before things get ugly, because that's another things about number and bubbles.
So yeah, I think you're specifically talking about Nvidia and some of the other stocks that were exposed to this stuff.
Yeah,
What there was super micro SMCI that had what the accounting scandal, and the shares crashed temporarily, and then they started rallying again despite the accounting scandal. Only a few months after the accounting scandal.
exactly. And what it's the attention problem and these people have. I mean, in the moment that I saw the big article from the Wall Street Journal out there talking about circular financing, I was like, this is it. It's over. No, they kept rallying. Oracle rallied 40% in a day when they announced those giant amount of RPOs. That is basically OpenAI nonsense. And I challenge everyone out there, look at the reaction of all CEOs, commentators, and whatever. The latest one has been during the Broadcom investor call. Every single person that has been asked to comment on the fact whether OpenAI will be able to pay for its commitment put on a clown show, pretty much. It's like, oh, well, yeah, they will grow. Yeah, I think so. Yeah, we believe in them, blah, blah, blah. I'm like, do they have the money to pay you? That's a question. I mean, once upon a time, these RPOs were not even reported because they don't mean anything. You start reporting future orders in the moment someone gives you a chunky cash up front as a collateral. It's like, okay, I'm going to expand my operations. I'm going to expand my production or whatever because I have collateral commitment, and then I have guarantees that I'm going to get the money. If not from them, from the banks that they are issuing the guarantees upon this commitment. That's not the case.
Well, the banks are supposed.
Anymore.
The rumor is that the banks are trying to offload this data center debt because they know it's bad. They're trying to find some suckers, what pension funds, or to chop it up into an income product or something to dump onto real estate investors.
That's totally correct. And what is more shocking to me is that I put a tweet out there a few months ago after the latest core wave. No, not the latest. Sorry, the previous core wave 10Q. And there is a chart in that 10Q. The core wave themselves put it, and whoever looks at that chart and has 2 grams of gray matter in his skull will see immediately how that is a Ponzi scheme, effectively. You're trying to raise money in order to finance the previous commitments that you had in place. So you're using future clients' money to finance today's commitments. And this commitment that they have today is basically one customer, it's Microsoft, for the most.
Well, that's surprising CoreWeave's doing that because I thought they were partners with Nvidia because didn't they start off, it was a bunch of hedge fund guys out of New York and New Jersey. They started CoreWeave as a shell company back in like 2017 or 18, and it was just doing crypto mining. And Nvidia was, I think, like basically giving them discounted loans to go buy the graphics cards to do the crypto mining. So there was like shady
Exactly.
shenanigans there years ago, many years ago.
I wrote an article about that. I put the SEC fine and statement that was put out at that time. And let's not forget, there is still a class action ongoing because the US Supreme Court didn't dismiss it. There is still a class action ongoing about that. And no, people don't even care. So they were already doing that stuff. They already got caught and fined for the stuff. And they are doing it again at a biblical proportion now. How is this going to end? I mean, like
I'd rather
people.
just hedge this stuff rather than try to time it shorting or betting it's going to crash because who knows, like, which the rumor is what Sam Altman was in Washington, D.C., working both political parties, trying to negotiate some type of subsidy or bailout or something like that. He's obviously, because of how effective lobbying is here in Washington, D.C. area, he was obviously trying to work that angle. He might end up getting some lobbying dollars. Who knows what happens with Congress or the White House a couple years from now. I'd just rather, as an investor, looking at this stuff, I can't tell you exactly what's going to happen, but probabilities, I mean, if they do the bailouts, if they subsidize or stimmy checks, those $2,000 stimmy checks or whatever that you're saying they're claiming it's going to be from tariffs. I don't believe that either. If they do print the stimmy checks, I'd rather just, I think gold's going to 5,000. I think silver, you were talking about triple digits by March. I don't know about March, but I think we will see triple digit if they're going to do these bailouts like at hundreds of billions of dollars or give out stimmy checks. I mean, we're going to see gold at 5,000 or silver at $100 pretty easily in the next couple of years.
Yeah, that's correct. Although I would like to clarify one thing. Gold is a pure monetary asset. So the effect on gold is going to be higher from this policy. Silver is still too cheap to be a monetary asset. So it's actually more of an industrial asset than what people appreciate. And actually, the demand of silver has been growing steadily while the production remained at an incredibly low level. So to the point that for several years and for the foreseeable future, there is a strong deficit in supply of physical silver. So the first repricing in silver is actually going to be of a factor of scarcity of the physical stuff. Then when the price will get to a point that it becomes a viable monetary resource, because silver takes a lot of space right now, compared to gold. But if silver reprices to where historically the silver gold ratio has been, then it becomes a monetary asset. And frankly, as I kept telling people for years, I always had like a lot of gold and silver because ultimately any type of asset with an inherent level of scarcity and growing demand while the scarcity degree worsen is going to be bound to significantly increase in pricing in a very extreme monetary inflationary environment like the one we are living today.
Well, plus there will be a slow supply response on the silver side because the majority of annual silver production is on a byproduct. The largest producers of silver used to be Peru 10 years ago. It's now falling like a rock. It's very tough to bring on a new silver mine. Some of the best silver projects are delayed. They might not come online at all. There's a huge silver mine in Guatemala called Escobal. There's another large silver mine in Argentina called La Navidad. That mine might not go into production for many, many years. Escobal has been offline for the last couple of years. They built out the mine and now it's shut down with an environmental protest. I think you brought up an important point here with like commodities, like whether it's gold, silver, platinum, and palladium. For many, many years, the price was so low, they were at or below the production cost, especially for silver. Silver was, in many instances, below the production cost for a lot of these miners. So a lot of the silver miners, Dario, had to leave producing silver. They had to go buy a gold mine just so that way they didn't go bankrupt.
Correct. That's perfectly correct.
So you have visited. This is very interesting since you're in Hong Kong and you go to China. Are you seeing a lot of long lines at gold and silver bullion dealers? Is there what is the industrial demand for silver out of China right now? What is it for? The
This is
industrial.
very interesting. I visit the Shenzhen market pretty often because I go there to buy Christmas gifts. So in this period, I went there the last weekend, but I periodically go. And I put out this famous tweet like a while ago, 2 years ago, around the same period, when the gold price was 1800, and I told people like, guys, you don't understand. Here, people were calling a top on gold at that time. I remember I was like, oh my God, this is completely ridiculous. And I told them, you don't understand. Chinese people are buying all the physical gold they can get their hands of. Chinese people don't like stocks, they don't like paper investments and whatever. They like hard investments. They took a big hit with real estate and they moved into gold. And from that tweet to today, the price of gold is 2.5 times higher. Not 25% higher, 2.5 times higher. Now, actually, gold is a bit expensive for people that miss the train. So what you actually see in China right now, you don't see lines to buy silver yet because there is always like this skepticism about silver of being a very like unreliable assets if things go in the wrong way in financial markets. So people have been burned before several times in history. And so they are really ignoring this fact of this industrial demand. So what you see right now is very large industrial demand. You see 15 kilograms bar of raw silvers being delivered like around the clock, and people are buying a ton of that because they need to have that in order not to stop their industrial production.
Is this for electronics or jewelry or solar panels? What are the industrial end users? Which industry are they in?
Jewelry is not that much in the grand scheme of things. Mostly is like EVs, semiconductors, solar panel, electricity, like conducting system. I mean, you need in the Samsung just announced they have this new solid state battery technology for EVs that is going to be groundbreaking and is going to solve so many problems that EV cars have nowadays. There is a small problem with that. The small problem is that you need 1 kilogram of silver for every battery. 1 freaking kilo of silver. And then people say, okay, but then, they can start recycling. I mean, no, that's not how does it work. In order for silver to become economically viable, to start recycling it, the price of silver needs to go beyond $150. So you can have all that industrial structure that you need to collect all these like junk electronics, EVs and whatever around, scrap them, extract the silver and repurpose that. But till you reach that level, it's not going to be economically viable. To do it is very expensive.
Yeah, because the silver is in small trace amounts and like contact switches, and it's in junkyards and landfills, and it's energy intensive, it's time consuming, it's very difficult to extract a tiny amount of silver out of a junkyard or landfill. Like you said, you need triple digit silver at least for the economic incentive for someone to make the investments into recycling all that difficulty you waste.
Exactly. Just to give you a sense of the matter here, for every phone, roughly there are 7 milligrams of silver. But without those 7 milligrams of silver, you cannot build the phone. The phone doesn't work because everything became so thin, so efficient, so whatever. So you need a metal with very high conductivity. And people say, oh, but silver can be replaced. Yes. As Mike Maloney said, actually quoting one of my tweets, it can be replaced by gold, platinum, and palladium. So in order to be replaceable, the silver price needs to get to those levels. to be replaceable in the supply chain. So it's not possible.
Okay, so it sounds like it's more or less irreplaceable unless it's at a certain price. It's similar to the rare earth permanent magnets too. Those things are difficult to replace as well.
Exactly. That's totally correct. So, I mean, to conclude on this matter, people should really like watch themselves, because in the past years, like stocks have been considered an inflation edge. Frankly, it only worked in some countries. If you look like at China, for example, like there is this huge divergence, as I said, or whatever, and this incredibly multiple expansions has been possible because monetary inflation. But once the hard reality of business economics hits, and people realize that Nvidia, as it stands right now, in order to recover their investments, has to pay as dividend 100% of its revenues for the next 30 years just to recover your investment, that is going to be a moment where you are going to see, because liquidity is not going to disappear, it's going to slosh around in the system. So the amount of demand for commodities in particular, and for anything that is going to be related to that space with inherent scarcity, is going to be enormous.
Well, also the central banks, Dario, outside of the G7, so the BRICS and the non-G7 central banks, they do not like the policies from either political party, the White House and Congress, from Washington, D.C. with sanctions. The amount of monthly gold purchases, the gold tonnage purchases after the Russia sanctions in 2022, when the $300 billion of reserve assets were confiscated and the interest payments were confiscated, they've about doubled. And if you listen to the comments from the central bankers in Poland and elsewhere, they sound like they read your articles and read Austrian school economics. They sound like we're just buying gold here as an inflation hedge or a currency debasement hedge against Washington, D.C. doing dumb policies, whether they're bailouts or quantitative easing or bad, not just tariffs, but, other sanctions on people that DC decides all of a sudden, oh, we don't like Russia, oh, we don't like Venezuela, those types of things.
Yes, this is correct. But also another element that the people should bear in mind is that we are talking nominal prices here. If you look at the purchasing power of 1 ounce of gold through history, it has been one of the few assets that constantly maintain the level of purchasing power. So if there is a market crash, whatever, the price goes down, it's not going to bother me, because the purchasing power of that ounce of gold is going to remain intact. What is going to change is eventually, and cause prices to crash, is monetary supply destruction. That nevertheless is going to be temporary, because these people, they have no other playbook that keep printing a whole bunch of new money in order to reinflate things all the way back up. And Ben Bernanke even got a Nobel Prize for this. Sorry, he got, the guy was saying, oh, there is going to be a trickle-down effect into the economy. We're going to inflate asset prices, going to benefit everyone. No, you created the worst wealth inequality in hundreds of years out there, effectively bringing back society to a level of inequality and poverty to a certain extent. It wasn't seen since the era of industrial revolution almost.
Yeah, it's creating a record wealth disparity because what less than 10% of the American population owns the majority of the assets here in the United States, the exposure to the stock market and expensive real estate and lots of physical gold and things like that. Actually, Ben Bernanke, wasn't he hired as a consultant, I think not just by hedge funds, but by the Bank of Japan? Didn't he recommend like zero coupon perpetual bonds? I know you're a bond guy. That sounds like a Ponzi scheme to me.
Yeah, man. Don't get me started on that, otherwise this interview is gonna last for other 6 hours.
Okay, basically, then, the policy decisions for a lot of these PhD economists, I mean, like I call it stagflate tax lie. They're looking at the cancel on effect. It's just easier for the people in power in Washington D.C. They don't like deflation for a bunch of reasons. That means what? Less economic activity, less tax receipts for sales tax, less income tax, less corporate taxes. The asset prices fall. That means less capital gains tax and property taxes. That's bad for a government that's as in debt as the U.S. federal government.
Yeah, of course. Like, I mean, deficit is gonna hurt, and they need to finance that.
And that's then we're getting into the real reason for QE. So they said one reason for quantitative easing in the past in 2008, 2009, and 2020. I don't think that that was a real reason. One of the main reasons was tax receipts dropped by 20% or more in a short amount of time, and quantitative easing was put in place to help make sure the government gets funded.
Yeah, yeah, that's correct.
Well, might be back there. It's starting to sound what we're starting to see you pointing out what the repo spikes are happening. The reserve levels are dangerously low. What Jerome Powell is back to repeating almost the exact same speech he did during in summer 2019 during that repo crisis when the Fed's balance sheet increased by $1 trillion in 3 months, give or take, in 2019. He said this is not QE back then, and the Fed's balance sheet increased by $1 trillion in 3 months. Oh, we're just going to increase reserves in the banking system. So it's not QE, but the Fed's balance sheet is increasing. Go try to think on that one.
I mean, man, I don't want to comment on that further because it's unnecessary. I mean, it's out there, and it's ridiculous.
Well, it's just more games. They'll call it something else. It probably won't be called quantitative easing. Who knows what it's going to be called? It'll be an emergency liquidity program. It'll be an emergency liquidity program like BTFP or one of these other ones. But the Fed's balance sheet will probably increase substantially in size.
Yeah, of course. Like it will increase in size, and they will undo. I mean, they the right now the level of the index of financial conditions is even lower than even before they started hiking rates. I mean, the Fed not only didn't hike rates high enough, because if they did, the whole banking system was going to collapse in 2023.
Yep.
Not only they didn't do that, but because they fell short in getting to a real level where they put inflation under control, the next wave of inflation is going to be even greater, even more painful. So their balance sheet, of course, is going to balloon and debase the currency. But again, you need to look at this thing globally speaking. Which currency is going to debase the most? So ultimately, the dollar might even end up appreciating compared to the other currency. So what the real indicator of currency debasement is gold.
I agree. And I think that's like the safest way to bet against the system is by hedging. Inflation hedges real stuff, real assets. Especially,
Correct.
2 or 3 years ago, platinum and palladium was a good trade. It was below the cost of production back then.
That's totally correct. And people should learn how to handle this kind of situation, looking at what Germans, some very intelligent Germans did during the Weimar Republic, where there was an incredible level of hyperinflation, and how these people handled it effectively was holding assets, hard assets or productive assets that allowed them to have income in other currencies that were debasing like at a slower speed, if not debasing but strengthening, like the US dollar. So at that time, actually, a lot of the family that ended up making a ton of like generational money is because they were exporting and getting foreign currency instead of their local one.
Well, I think we should just wrap up on that. I've kept you for over an hour. It just sounds like we're going to see a lot more rules changes in debasement. I don't think that we're going to be getting stimmy checks for the tariff revenue. I mean, they said other stuff about Doge and how much savings that we were going to get a Doge dividend from $1 trillion or $2 trillion in savings. They got to about 10% of that, I think, with about 200 billion give or take in government savings compared to their goal of what around 2 trillion. So like I've been right outside of Washington D.C. for 25 years. A lot of the stuff they say in public, it ends up being a lie or it doesn't come to fruition.
Yeah, I'm totally with you on this.
Okay, well, thank you so much for your time today, Dario. I definitely want to have you back. This was awesome. And
Yeah.
I'll put a link to your macro blog article. You have more in-depth articles behind the paywall, and you also have a podcast too on YouTube, right?
Well, actually, I don't have a paywall. Everything I've done was always free for everyone because I'm not doing this, for a living. I'm doing this as a hobby. I actually manage my portfolio based on what I write, and it allows me to, get going pretty nicely. And even if I don't touch stocks, even with a 10-foot pole, so
Well, it's important to practice what you preach. They say you can't trust a chef who doesn't eat his own cooking. So,
exactly, exactly.